Good evening, and you are welcome to the next session of our class. We ended our previous lecture by looking at the basis of accounting, where we looked at the cash basis of accounting, the accrual basis of accounting, and the breakup basis of accounting. And we looked at situations which will warrant the use of any one of the bases that we discussed. Okay, today we're going to continue our discussions from section 4. In section 4, we are looking at the need for financial statements. Now, we are expected at the end of this section to know, 1, the objective of financial reporting, 2, the information needs of those who use financial statements, or simply put, the users of financial accounting information and the information they require. Good. So let's look at the objects of financial reporting, or the objective of financial reporting. Now, according to the International Accounting Standards Board, the objective of financial reporting is to provide information about the financial performance, the financial position, and changes in financial position of an enterprise that is useful to a wide range of users in making economic decisions. Good. Again, the objective of a general purpose financial reporting is to provide financial information about the reporting entity that is useful to present, existing, and potential equity investors, lenders, and other creditors in decisions about providing resources to the entity. In other words, financial statements are prepared to provide information that should be useful to most users, but will not necessarily satisfy all of their needs. Okay, so what do we mean? Now, according to IASB, there is the need for an entity to prepare financial statement because once the financial statements are prepared, it provides information on the entity's financial position, the entity's financial performance, and the changes in the financial position of the entity. Okay, because an entity's performance for year 1 or the entity's financial position for year 1 might not be the same as the entity's financial position for year 2. So when financial statements are prepared, it throws light, okay, on the financial position, the financial performance, and changes in financial position of the entity over time. Okay, good. And that helps the users of financial accounting information to take very important decisions. Okay, to take very important decisions. Now, for example, if I happen to be an investor or a shareholder in a company, now, in order to know how my investment is doing, I would like to know the entity's performance. How do I get to know the entity's performance? It's only when the organization prepares its financial statement. Okay, good. So once the financial statements are prepared, okay, I'll be able to tell how the company is doing by looking at their financial statement in terms of their financial position, their financial performance, and changes in the financial position of the entity. Okay, good. So again, if you look at the second object, we said that the objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to present, existing, and potential equity investors, lenders, and other creditors in decisions about providing resources to the entity. So if I happen to be a potential investor, okay, I want to come and invest in company A. Company A has been in existence for 5 years. Now, I would like to know, okay, the state in which the company has been in for the past 5 years. Okay, and how do I get to know? It is only when the organization prepares its financial statement. Do you get a point? Good. So the Object of financial reporting is that it helps prospective investors, creditors, lenders to make important decisions about providing resource. Because if I happen to be, say, a supplier, who you have contacted, okay, maybe a company A has contacted me to supply goods to them, okay. Now, if I know that the company has been in existence for some time, I would like to see their financial statements, okay, and have an analysis done to find out whether the company will be in position to pay me when I supply them the goods. You get a point? Good. So these are some of the reasons why it is important, okay, for financial reporting, or these are some of the objectives of financial reporting. It is important so that existing, current, and prospective investors take decisions about providing resources to the entity. Good. And again, we are saying that financial statements are prepared to provide information that should be useful to most users, but will not necessarily satisfy all of their needs. Okay. Now, when financial statements are prepared, okay, they are termed as general purpose, in that it is not prepared to satisfy any specific user's needs. So, for example, if, say, GCB Bank, okay, publish their financial statement in the dailies, that financial statement is not directed to any specific user. Okay, all users can make use of it, and that makes the financial statement prepared by, say, GCB a general purpose financial statement. It's a financial statement that will be of use to varied users, or different class of users. Good. So those are the objectives of financial reporting. Now we are going to look at the users of accounting information and their information needs. The users of accounting information and their information needs. Good. Now, these are the users of accounting information are investors, we have lenders, we have suppliers and other trade creditors, we have the government, we have the general public, we have employees, we have customers, and we have managers. These are users of accounting information. These are the class of people who make use of accounting information. Now, what specific information will each one of these require from the business? So when you take investors, investors would like to know how the company is performing, or how the company has performed over some period of time. Okay, good. Because as investors, what they are interested in is a return on the investment that they have made, by way of, if it is a shareholder, by way of dividend and capital appreciation. Okay, good. So an investor will be interested in the financial performance of an entity. The financial performance of the entity. Okay, good. Lenders are also interested in the financial position of the entity, because if you look at an entity's financial position, you can tell from the statement of financial position whether the company is liquid or not. Okay, good. So as a lender, what I'm interested in is for the company to be able to make good my loan, my principal, and my interest. Because if I lend to the business, I'll be expecting interest, as well as payment of the principal that I lent. Okay, so they'll be interested in the liquidity of the entity. That is, will the entity be able to meet their debts as and when they fall due? Good. For suppliers and other creditors, I will liken them to that of lenders, because if I supply goods to a business, my interest will be, okay, when I give them some period to pay, when the time is due, will they be able to pay? So creditors or suppliers and other trade creditors will be interested in the liquidity of the entity. Okay, will the entity be able to meet their debts? Will they be able to pay me when the debt falls due? Good. What of the government? The government. Now, Government will be interested in a business entity through many of its agencies. Okay, for example, the Ghana Revenue Authority. Okay, if the entity is not exempt from tax and it's a tax paying entity, then the government will be interested, okay, in the performance of the entity. That is, would the company make good its taxes? Okay, because if you're a corporate entity and at the end of a particular year you make a profit, there is the need for you to pay your tax. That is, if you are not exempted from taxation, okay, there is the need for you to pay your tax. So the government will be interested, okay, in some of these things. Good. Now I leave you with another assignment to look out for the information needs of the public, employees, customers, and managers. Okay, so in our interactive section, we will discuss their information needs. So I expect that at our interactive session, you have solutions for this. Then we will discuss, brainstorm, and polish them for it to be at our fingertips, because these are examinable areas. These are examinable areas. You must pay particular attention to some of these areas. Okay, good. So the users of accounting information and their information needs. So we've looked at investors, you have looked at lenders, you have looked at suppliers and other trade creditors, and looked at the government. So now it's your responsibility to look out for the kind of information that the public will need, the kind of information employees will require, the kind of information customers will require, the kind of information managers will require from the financial statement of an entity. Great. Now let's look at the components of financial statements. The components of financial statements. Okay. Now, at the end of this section, students should have an appreciation of the following. 1. What constitutes a full set of financial statements? What constitutes a full set of financial statements? What constitutes a full set of financial statements? 2. What statement of financial position entails? What statement of financial position entails? 3. What statement of profit or loss and other comprehensive income is composed of? 4. The relationship between the statement of profit or loss and other comprehensive income and the statement of financial position. Is there any relationship between the statement of profit or loss and other comprehensive income and the statement of financial position? We get to know. Then the statement of changes in equity. Students should know what is statement of changes in equity, or what is the makeup, or what items are considered as equity items. Good. So let's look at the constituents of a financial statement. The constituent of a financial statement. Now, financial statement. Now, a full set or the component of financial statements would include the following. 1. A statement of financial position. Statement of financial position. 2. We have the statement of profit or loss and other comprehensive income. 3. We have the statement of changes in equity. We have the statement of changes in equity. Then we have the statement of cash flows. And finally, we have the note forming part of the financial statements. So we have 5 components of a financial statement, and that comprise the statement of financial position, which is formally known as the balance sheet. Then we have the statement of profit or loss or other comprehensive income, which we usually refer to as profit or loss. Then we have the statement of changes in equity, the statement of changes in equity. Okay. Then we have the statement of cash flows and note forming parts of the financial statement. Good. Don't worry. We will look at this in detail when we get to the conceptual framework. Okay. Great. Now let's look at the statement of financial position. The statement of financial position. Now, what goes into the statement of financial position? Good. Now, a statement of financial position is a list of the assets and liabilities of an entity as at a particular date. So the balance sheet contains information on the assets of an entity, the liabilities of an entity, and the equity of an entity. Okay, and the equity that the entity has registered, or the number of shares that the company is registered. Okay, good. Now, we will look at what an asset is. We will look at what liabilities are. We will look at what equity is. When we talk about equity, what does it mean? We will look at it. Great. Now, at this point, what I would like you to know is that note that when we talk about financial position, it comprises the assets, the liabilities, and the equity of an entity. Good. What of the statement of profit or loss and other comprehensive income? Now, this statement provides information about the performance of an entity in a period. It consists of two parts. So as the heading goes, statement of profit or loss and other comprehensive income. So we have the profits and loss parts, and we have the other comprehensive income parts. Good. So a statement of profit or loss will look at the list of income and expenses which results in a profit or loss for the period. So the profit and loss bit will look at, okay, all the incomes that the company generated less the expenses. Okay, that will give us either a profit or a loss. Then we have the statement of other comprehensive income, which contains a list of other gains and losses that have arisen in the period. Okay, now note very well that transactions that would appear in the statement of comprehensive income is not covered in our syllabus. That is paper 1.1. It is not covered in our syllabus, paper 1.1. Great. What that means is that it's a financial reporting. It is a financial reporting issue. That is, it will be treated under financial reporting. So level 2. That is where we look at comprehensive income items. Okay. However, in our discussion, should we come across any item which is considered as other comprehensive income, I will draw your attention to it. So you take note of it before you get to level 2. Great. Now, let's look at the relationship between statement of profit or loss and other comprehensive income. The relationship between the statement of profit or loss and other comprehensive income and the statement of financial position. Don't forget that the statement of profit or loss and other comprehensive income is one statement, okay, just divided into two sections, the profit and loss side and the other comprehensive income side, okay. So we are looking at the relationship that exists between the statement of profit or loss and other comprehensive income and the statement of financial position. Great. Now, the statement of financial position shows the equity of a business at a point in time. In practice, the balances from the previous year are also included. These are known as the comparatives. So those of us who have come across the financial statement of entities, you see that always, especially published accounts, you will see that the current year's financial statement will be there, and the prior year financial statement will also be there. Okay, so the prior year figures, okay, are referred to as the comparatives. Okay, great. Now, the statement of profit or loss, on the other hand, ends with a figure showing the net profit or loss for the period. Profit belongs to owners of the business. It is therefore an addition to equity. So you can see that the results of the profit or loss and other comprehensive income will be added to the owner's equity in the statement of financial position. Okay, now you will see this, okay, when we start preparing basic financial statement, and I'll draw your attention to this. Okay, good. So the end results of the statement of profit or loss will be transferred to the statement of financial position. Okay, great. Now the statement of profit or loss links last year's statement of financial position to the one constructed at the end of the current year. Okay, it links the profit or loss, right, to the last year's statement of financial position. Okay, good. So what it means is that, assuming I prepare financial statement for 2018, okay, the profit or loss that I made this year, that is in 2018, when I go to 2019, okay, that income surplus balance, or the profit or loss balance, or the profit or loss that I made in 2018 becomes an opening balance in 2019. Do you get me? And the current year's profit or loss is added on. Okay, great. Then what is the makeup of statement of changes in equity? When you talk about statement of changes in equity, what are we looking at? Now, the relationship between the opening equity and the closing equity is shown in a statement of changes in equity. In practice, equity would be made up of a number of different balances, each with a separate column in the statement of changes in equity. Okay, great. Now, we will also look at a typical statement of changes in equity. Okay, in our interactive section, I will make sure that I present a statement of financial position so that you know what goes in there, statement of profit or loss and other comprehensive income. I'll also show you an illustration on the statement of changes in equity so that you know what items are considered as equity items. Okay, great. Now let's look at business transactions. Business transactions. When you talk about a transaction, what does it mean? So the import of this session is that students should know the difference between capital transactions and revenue transactions. Then again, know the difference between capital expenditure and revenue expenditure. And again, know the difference between income receipts and revenue receipts. Okay. Now, a business transaction is an activity or event that can be measured in terms of money and which affects the financial position or operations of the business entity. A business transaction has an effect on any of the accounting elements. Okay, so when you look at elements of a financial statement, we are looking at the items that we use in preparing the components. Don't forget that we have looked at the component of financial statement to be the statement of financial position, statement of profit or loss and other comprehensive income, the statement of changes in equity, okay, statement of cash flows, and note forming parts of the financial statement. Now, these components are prepared using the elements of a financial statement. Because in the statement of financial position, you will see assets in there, you will see liabilities in there, you will see equity in there. Okay, in the statement of profits or loss and other comprehensive income, you see information on income and what expenses. So one can say that the elements of financial statements are used in the preparation of the components of financial statements. Good. So when you talk about elements of financial statement, you're talking about assets, you're talking about liabilities, you're talking about capital, you're looking at income, and we are looking at what? Expenses. Wonderful. Now, it can also refer, a business transaction can also refer to the interaction between a business and its customers, suppliers, or any other party with whom they do business. Okay? It is an economic event that must be recorded in the business's accounting system. So simply put, a business transaction is any economic transaction that can be quantified in monetary terms. Okay, that can be quantified in monetary terms. Don't forget that we define accounting as the act of recording, okay, classifying, summarizing, interpreting financial information. Okay, good. So now, if a particular transaction cannot be quantified, we cannot put value on a transaction, then in accounting, okay, it will be very difficult for us to put value to it. So a business transaction is any economic activity or event that can be measured in terms of money. So simply put, a business transaction is an economic event that can be quantified in monetary terms. Once we can quantify it, then we can record it, because you are looking at valuation and measurement. Okay, we should be able to put value to it, because in accounting we look at figures. Okay, even though we add some qualitative aspect to it, which are information to bring out meaning and understanding to the figures which we have recorded. Great. Now, the following are typical examples, or are examples of business transactions. Let's look at them. 1, purchasing goods and materials. Purchases can be made for cash or credit. Now, a business enterprise who is into buying and selling, for example, can go to a supplier, buy the goods, pay cash, okay, and also come and sell. Or they can have an agreement with the supplier to give them the goods on credit and pay later. Okay, great. Another example is procuring services or purchasing service. For example, repairs to equipment, advertising, printing. So when a business wants to advertise its products, they can use any medium, whether through the internet, radio stations, television, among others. Okay, great. Sales. When a company is making sales, okay, a typical example, if I happen to maybe deal in sale of spare parts, okay, I can sell for cash and I can also sell for credits, on credits. Okay, that is if I have a relationship, business relationship with you. I know that you are credit wealthy, or I've been trading with you for some time, and I know that anytime I give you goods, you come back and pay. I can easily give you credit, okay, or I can sell to other people for cash. Great. Then paying wages and salaries is also a business transaction, because if someone comes to work for a business, the person needs to be paid. Okay, great. Purchasing of non-current assets. So the company acquires fixed assets, or what is called PPE. Okay, now it's a business transaction. Great. So these are some examples of business or transactions. Okay, good. We'll be looking at more of this in our later discussions. Great. So that's a business transaction. When we talk about business transaction, we are looking at any economic activity event that we can put value on it, or that we can measure, or that we can quantify in monetary terms. Okay, great. Now, let's look at the classification of business transactions. The classification of business transactions. Now, business transactions can be classified in a number of ways: as simple transactions and as complex transactions, as one-off transactions and as ongoing transactions, as capital transaction and as revenue transaction. Okay, good. So what does it mean? What do this mean? Okay, now we will look at it. So let's look at capital transactions and revenue transactions. Now, when we talk about capital transactions, they are transactions that result in the acquisition of non-current assets. Okay, capital transactions are transactions that result in the acquisition of non-current assets, or what is called fixed assets. Those of us who did business in SS, we used to call them fixed assets. Okay, good. So example, land, building, office equipment, plant and machinery. Okay, or raising long-term debt. Raising long-term debt. So if a company goes in for a bank loan, okay, if a company issues debentures, okay, they are seen as capital transactions. So either they result in the acquisition of non-current assets or the raising of long-term debt. Okay, now these transactions also appear in the statement of financial position. Great. When we talk about revenue transactions, they are transactions that are generally of short-term nature and are only expected to benefit the current period. Okay, good. Revenue transactions appear in the profit and loss account of the period. So a typical example of revenue transaction is what? Revenue. Okay, when you sell goods this period, okay, the revenue relates to just this period. It doesn't go into next year. Okay, good. Then, for example, when you make payments of employees' salaries, the salaries cover the period, which is, if it's a year, all the salaries that you pay in a year expires within the year because they work within that year and you got them paid. That is it. When they move on to the next year, you have to pay them separately in that year as well. Okay, great. Then what of capital and revenue expenditure? Okay, so what is capital and revenue expenditure? So note that there's a thin line between a capital transaction and a capital expenditure. And there's a thin line between revenue expenditure and a revenue transaction. Okay, a revenue transaction can either be an expense in nature or an income in nature. Okay, let's take note of that. Great. Now, capital expenditure is an amount spent to acquire or significantly improve the capacity or capabilities of long-term assets such as equipment, buildings. Okay, usually the cost is recorded in the statement of financial position and is reported under the heading of property, plant, and equipment, or simply put, PPE. The assets cost, except for cost of land, would then be allocated to depreciation expense over the useful life of the assets. So what you are looking at here is that capital expenditure, okay, benefits the organization for more than one accounting period. For example, if a company buys a vehicle, you don't expect that the company will expense or will consider the vehicle as an expense in that accounting period. No, it will be a huge blow to the company. So normally, capital expenditure are spread over the lifespan of that particular asset. Do you get me? Great. Now, a capital asset is a non-current asset. The ISB defines capitalization as recognizing a cost as an asset or part of the cost of an asset. So when an item of cost is capitalized, it is treated as an asset rather than what? An expense. So when you hear of capitalization of assets, it means that we are recognizing a cost, okay, or part of the cost of an item, okay, as an asset, okay, capitalization. So when an item of cost is capitalized, it is treated as an asset. So when you hear of capitalization, oh, I'm capitalizing this, then it means that you are considering the value of that item as what? As a capital expenditure. And therefore, you need to spread the cost over the period that it will benefit the organization. Good. When you talk about revenue expenditure, it's an amount that is spent for an expense that will be matched immediately with the revenue reported on the current period's income statement. It's expenditure on day-to-day operating expenses. Examples of revenue expenditure include the amount spent on repairs and maintenance, selling, general, and administrative expenses. Those expenses expire within one accounting period. Okay, so that is what is meant by revenue expenditure. So I hope and I trust that you'll be able to distinguish between what a capital expenditure is and what a revenue expenditure is. Capital expenditure benefits the company for more than one accounting period, whereas revenue expenditure, okay, benefits the company for just a year, or will be of benefit to come for just a year. Okay, and revenue expenditure are also those expenses that are incurred in earning revenue. Okay, great. Then let's look at revenue, income, and capital receipts. Now, when we talk about revenue income, it is the income arising from the normal operations of a business, from its investments. Example, revenue from sale of goods, commission and fees received and receivable from provision of service, interest received and receivable from savings, rent received and receivable from letting out property. Revenue is reported in the statement of profit or loss and other comprehensive income. Okay, so when we talk about revenue income, we are looking at the income from the core operations of a company. Okay, so if I'm into banking, then my core income is the income that I get from loans, because they are into the business of giving out loans. Okay, so when I give loans, I charge interest on it. So the interest income on loans happens to be my my revenue income. I hope it's understood. Good. If you are into insurance, okay, then your revenue would be the premium. the insurance premium that you take. Okay, great. Now, when you talk about capital receipts are of long-term nature, okay, or they are long-term income, such as money from a bank loan or new money invested by business owners. So when there's an injection of capital into the business by the owners of the business, okay, it is seen as a capital receipt. Or if the company goes to borrow from a bank, or if the company issues outwards debenture, okay, they are considered, the proceeds from that is considered as a capital receipt, and that affects the statement of financial position of the entity and not its financial performance. So as revenue income affect the financial performance of an entity, capital receipts affect the statement of financial position. I hope I've made myself clear. Great. Now, let's now look at the duties and responsibilities of those charged with governance. When we talk about responsibility and duties of those charged with governance, what do we mean? Who are those charged with governance? Now, when we talk about those charged with governance, don't forget that at our introductory section, I did mention that if you have a company, the company is being owned by what? Shareholders, being the owners. Now, these owners are not the people who run the business, especially if it is not an owner-managed company. Then the owners would have to appoint some class of people who will oversee the running of the business. Call this class of people what? Board of what? Directors. Okay. So now, when we talk about board of directors or those charged with governance, when we talk about those charged with governance, we are referring to the board of what? Directors, because they are those that the shareholders have put in their stead to see to the running of the what? Of the business. Okay. So the duties and responsibilities of those charged with governance. Good. Now, the import of this session is that students should have an understanding of what governance entails and the responsibilities of those charged with governance in the context of preparation of financial statements. Then the duties and responsibilities of directors and others covering the preparation of financial statements. Okay, so what is corporate governance? What is corporate governance? Now, corporate governance is defined or has been defined in the Cadbury report, okay, of 1992 as corporate governance is the system by which companies are directed and controlled. Okay, the Cadbury report is a very important report. Okay, if you have time, just check online and learn more about it. Okay, how it came into being and its importance to the business environment. Okay, so corporate governance has been defined as the system by which companies are directed and controlled. That's what is meant by corporate governance. Now, governance should not be confused with management. There's a thin line between governance and management, because don't forget that I mentioned that the shareholders of limited liability companies are most often not the managers of their company. So they appoint people to man the business in their stead. And we call these people that the shareholders appoint as board of directors. Now, the board of directors happen to be experienced professionals who have expertise in varied fields, from banking to law to accounting to finance, among other fields. Okay, and so they may also not have time to sit at one place to see to the run of the business, but they have the business expertise. Okay, so they also in turn appoint some class of people to carry out their responsibility, which the shareholders have given them. So the class of people that this board of directors appoints are called management. Okay, good. So the shareholders appoint directors. Directors appoint what? Management. Okay, good. So now, what is the difference between governance and management? Now, management is concerned with running the business operations of a company, whereas governance is about giving a lead to the company and monitoring and controlling management decisions. So I would say that governance is more strategic in nature, Okay, the board of directors will set the objectives, okay, the strategic goals of the company. However, management must make this objects a reality through their day-to-day what operation. Okay, so management is concerned with running business operations of a company, whereas governance is about giving a lead to the company and monitoring and controlling management decisions so as to ensure that the company's so as to ensure that the company achieves its intended purpose and what aims. Great. Now, corporate governance is concerned with matters such as in whose interest is a company governed? In whose interest is a company governed? Who has the power to make decisions for a company? For what aims or purposes are those powers used? Okay, in what manner are those powers used? Who else might influence the governance of a company? And how are risks managed? So these are some of the matters that are dealt with under corporate governance. Okay, great. Now, modern codes of corporate governance require that the board of directors should be properly accountable to its shareholders through published financial statements and should be open and transparent with investors generally. Okay, good. That's like the current dispensation. Okay, board of directors are supposed to be transparent in their dealings with the shareholders who have appointed them, so that the shareholders know what is happening, okay, or how their funds are being managed. Great. Now let's look at the duties and responsibilities of directors or those charged with governance as far as preparation of financial statements are concerned. Okay, as well as the preparation of financial statements. Good. Now, when we talk about the duties and responsibilities of directors for financial statements, one, the directors are responsible for the preparation of the financial statement in compliance with international financial reporting standards. Okay. Now, when you hear international financial reporting standards, okay, they are the conventions, the rules, the laws. Don't forget, we have looked at this. Okay. Now, they underpin the preparation of financial statements. We will look at that in much detail, the IFRS in much detail, so they get the understanding. Great. Now, they also institute internal controls which are necessary for the preparation of financial statements, which are free from material misstatement. As directors, they are responsible for putting in place internal controls which will ensure that the financial statements prepared are free from material misstatement. Okay. Now, the internal controls are structures that are put in place to ensure that the organization's resources, assets are safeguarded. Okay, good. So we will look at internal controls. Okay, good. When you get to level 2, when you do audits, you'll be introduced to internal controls. But basically, they're basically structures, mechanisms that are put in place by business organizations to ensure that the business is being managed properly. For example, you cannot have one person, okay, say being a cashier, being say the general manager, okay, being the accountant, okay, being the storekeeper, okay. Now, when that happens, that person might be compromised in a way, okay. So there's the need for segregation of duties, okay. This one should be in charge of stores. You should be in charge of sales. You should be in charge of reconciliation, so that when sales is made, okay, the cashier or the salesperson collects the money, the store person makes the goods available to the customer, okay. Then at the end of the day, there's somebody who should reconcile the account, so that this transaction is not performed by one person. If it is being performed by one person, there could be collusion, okay. There could be collusion and misappropriation could happen, okay. Great. So that's a typical form of internal control, okay. But you look at it in more detail when you advance in your studies, okay. Then we look at the third responsibility of directors. They are also responsible, okay, to ensure, okay, that the going concern assumption, okay, on which the financial statements are prepared, okay, is appropriate. Okay, so they also consider the appropriateness of the going concern assumption in the preparation of the financial statement. Because don't forget that the financial statement is prepared on the basis of going concern, in that the company will continue to exist into the foreseeable future. Okay, that is why you see the financial statement prepared. Okay, you see that there is a sign of continuity. So when a typical example, or those of us who have done business, you see that when we prepare ledgers, we say we should close the ledgers, okay, by introducing our balance carry down, our balance carry forward. It's a sign of continuity because the business has no intention to cease to operate. Do you get a point? Great. So we will look at the going concern assumption again in much detail. When we talk about going concern, what does it mean? It is one of the fundamental assumptions on which financial statements are prepared. They are prepared. That's why we look at the basis of accounting. We looked at what the accrual basis, the cash basis, and all the breakup. And we learned under the breakup that when an entity, okay, wants to discontinue with its operations, then there is a need for them to prepare their account on breakup basis. But if there is no going concern issue, then the financial statement are prepared on what? Either accrual basis or cash basis. But we did mention that the commonly or widely used basis is the accrual basis. Great. Now let's look at the other duties and responsibilities of directors. 4, they are also responsible for the detection of fraud and error. Yes, as directors, they should put in place sound internal controls which will help them to prevent, detect, and correct misstatements. That is, they should put in place structures, okay, that will help prevent fraud or errors from occurring. That is why in our various organizations, for those of us who are working, you can see that we have various levels of authority. Okay, so for example, in an account office, there will be a petty cashier, there will be a junior accountant, there will be a senior accountant. So for example, if the junior accountant, okay, prepares, say, bank reconciliation, that bank reconciliation should be reviewed by a more senior person to make sure that whatever recon that has been carried out is accurate. Do you get a point? Good. It's a way to check any errors or fraud from occurring. Okay, great. So it's the director's responsibility to put in place structures that will help them to detect fraud and error, and that could be done through the institution of internal controls. They are also responsible for keeping proper accounting records, which disclose with reasonable accuracy at any time the financial position of the company. Okay, good. Then they are responsible for safeguarding the asset of the company. As directors of the company, they must make sure that the asset that the business acquire are properly safeguarded. So you move into several businesses and we see that the company has either a security camera somewhere, or they have employ the services of a security company to keep watch over their property. It is the responsibility of the directors to ensure that the assets of the company are safeguarded. Okay, so these are some of the duties and responsibilities of directors as far as financial statement preparation is concerned. All right. So now that brings us to the end of our unit 1. That's chapter 1. Okay. Now we have some chapter review questions. Okay, I've outlined some questions, I've set some questions, I've given you some hints to how you can go about answering of the questions. Okay, so in our interactive section, we will pick some of them, okay, and discuss them in detail. Again, you need to also prepare, go through the notes, prepare all your questions, and at the interactive session, you can post that questions to me, and I will address your concerns. Okay, great. Now, what I want to state here is that the course is not difficult. It only becomes difficult if you pile the notes. So I implore each and every one of you to be consistent and committed to your studies. And if you continue that way, success awaits you. Okay, just be rest assured that you are in good hands. We make sure to give you the very best that will secure you your one touch of pass, because at one touch, your sure pass is our priority. Have a good evening and enjoy the rest of your evening. So we meet to discuss our next chapter. Have a good evening.